So there's really nothing more frightening, more alarming than waking up to bad news, particularly bad news that has a negative impact on your finances, on your money, on your hard-earned savings and investments, most importantly, which is why what we have seen happen here just in the last few hours, really, few days, weeks, and potentially more than likely projected, planned, and being prepared to happen more in the future as banks like Silvergate, Silicon Valley Bank, SVB, SIVB, Signature Bank, New York, putting the funds in the banks of the depositors as well as investments from investors, shareholders, bondholders at risk. Now, obviously, you could look at the situation and approach it dispassionately and determine that maybe it's in your best interest to trust and rely on the government. Mr. Biden, the FDIC, the Federal Reserve, the U.S. Treasury, Janet Yellen, and maybe they'll take care of you. Maybe they'll keep you protected. Maybe not. Warning, folks, all these savings accounts wiped out. Huge collapse has already happened. I mean, Silicon Valley Bank may not seem like that big a deal, but it was the 16th largest bank. What happens if the 10th largest bank collapses, becomes insolvent, has liquidity issues, sees inappropriate and downright illegal activities from within that then put everyone else at risk? It's a likely scenario. We've seen it happen before, and I can say confidently that we shall see it again. When, where, to what severity, I don't know. I don't have a crystal ball. However, history does tend to repeat itself. And the last thing that I would want to do is ignore all the warning signs and put my wealth at risk. And I know you guys are probably in a similar situation, thinking the same thing. I've worked hard for this money. I've worked hard for what I have, for everything that I've earned. And I'm not looking to have it all taken away from me in a blink of an eye, just like that, by some bank glitch or CEO selling off securities at a loss or dumping stocks, cooking the books, as this fractional reserve banking system is no more than an elaborate multi-level Ponzi pyramid that is okayed by the government. No one is above the law. And that's how capitalism works. These are going to be some great quotes to tell your kids and your grandkids down the road when they ask, why do we not have any money?
They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works.
Please don't let that happen to you. Please don't let that happen to you. I want to share with you what JP Morgan Chase, Charles Schwab, and 8 other banks have all done as a result. Yahoo Finance shares that JP Morgan Chase, Charles Schwab, and 8 other banks dropped in market value after SVB, Silicon Valley Bank crash. Question: is your money safe? There's a short answer to that. It says here that financial stocks took a pounding on March 13 as panicked investors aimed to cut their losses amid fears that the collapse of Silicon Valley Bank and Signature Bank will lead to even more bank failures. Many observers now envision a crisis similar to the Great Recession of 2007 to 2009, leaving shareholders and bank customers alike wondering about the safety of their investments and deposits. What we saw happen is unprecedented, but also unsustainable. You see what I'm saying? The 10 largest bank stocks in the United States lost a combined $76 billion. Billion with a B, okay? The 10 largest bank stocks in the United States lost a combined $76 billion in market capitalization on Monday, according to a Forbes report. Among the financial institutions hit were Charles Schwab and Truist Financial, each of which saw shares fall by double digits. Major national banks like JP Morgan Chase, Citigroup, and Bank of America also reported sell-offs, while shares of regional banks such as First Republic and Western Alliance sank 50% or more. That's huge, folks. I would have to assume that the only reason why Wells Fargo Bank is not mentioned is because Wells Fargo fumbled yet again on the Friday prior to this happening by not processing and restricting people from having the ability of receiving their weekly and bi-weekly paychecks through direct deposit through a glitch. Is your money safe? Is your money safe? Trading was so volatile that the NASDAQ trader website published a list of bank shares that were placed under a temporary regulatory halt, according to Newsweek's report. More than 20 bank stocks were on that list, including Charles Schwab, PacWest, Bancorp, East West Bancorp, and KeyCorp, which means that as the shit is hitting the fan, there's nothing you can do about it. Shares were placed under a temporary regulatory halt. It would be like your house is burning down and you're standing there watching it, and the fire department is standing there with a hose, but they're told that they need to wait and do nothing under this temporary regulatory halt. Who knows, by the time that they're allowed to actually engage, your house may have been a total loss, burned to the ground. I hope you had insurance on it. Now, the nation's 10 largest bank stocks have lost nearly $190 billion in value since Wednesday, March 9, which was the final trading session before SVB's collapse started dragging the sector down. All but one of the S&P 500's 25 worst performers on Monday were financial stocks. Now, for the savvy investor, they know what this means, okay? Now, also, as previously reported by Go Banking Rates, Silicon Valley Bank was closed by the California Department of Financial Protection and Innovation, which appointed the Federal Deposit Insurance Corporation, the FDIC, as a receiver. The last FDIC-insured institution to close was Almena State Bank in October of 2020. The collapse of SVB, Silicon Valley Bank, was considered a major red flag in the banking industry because of its size and influence. It even disrupted Etsy and Etsy sellers, gaining access to the funds of which they earn from the sales that they've produced. It says that it was the 16th largest bank in the United States, was 40 years old, and was important for high-tech startups. And this is according to John Mayer, Chief Investment Officer at Global X. Tech startups are inherently dangerous by nature. The banks that support them, and moving forward from this point on, you guys make your own call, make your own judgment, but I encourage you to do your homework. The impact, according to Mayer, on regional banks will be huge. From what Mayer wrote in an email note shared with Go Banking Rates, and expected consolidation, and the winners will be the big banks, those who will charge higher fees and be more restrictive onto whom they invest to. The losers will be startups with less access to capital. So there's that inherent risk I was telling you guys about. And what that means to me is that moving forward, I would be very, very selective, careful, and cautious about investing, and more importantly, relying on income from a tech startup that is clearly going to have struggles financially with gaining access to capital, affordable capital. Because I'll tell you guys right now, capital can be had by almost anybody, but the affordability of that capital will determine whether or not it will actually be useful. If someone were to try to gain access to capital today, we have higher interest rates pushed by the Fed. But if you find yourself in a situation where you're less than qualified, i.e. tech startups now gaining a black eye through no fault of their own, they're just in that group now, they're going to be categorized and stereotyped that way, they're not going to be considered overqualified. Therefore, they're going to have to pay a premium for access to capital. It says here that on Monday, Bank of America analyst Ibrahim Poonawalla cut his price targets for 24 regional banks by an average of 24%, citing potentially higher compliance costs for the companies amid more intense regulatory scrutiny. Expect layoffs, expect job cuts, expect bankruptcy, expect closures, expect wipeouts, expect shutdowns, expect catastrophic destruction within the tech industry, and do all you can to prepare. Schwab and other financial firms with massive bond holdings of longer maturities were especially impacted by the SVB failure, according to a CNBC report. And the fear is that these firms like Silicon Valley Bank will need to sell these holdings at huge losses in order to cover deposit withdrawals. Bad time to sell, folks. Remember, right now is the liquidation phase that I told you guys about a week ago. About a week and a half ago, I told you, after having a conversation with one of my good friends who happens to be, in my opinion, a financial expert, and he called it. Chris, you called it. The liquidation. Now, we thought this liquidation was going to come in the form of consumers, but this liquidation is actually coming in the form of, or he thought, is coming in the form of these businesses, these tech companies, these startups, going to the banks, withdrawing their money, not for the reason that he initially thought, but for the fact that gaining access to capital, lending, high interest rates right now is making it difficult to do that. Therefore, they're looking to use their own cash to be their own banks and fund their own businesses, which then hurts and puts a strain on the banks. Again, fractional reserve banking. Therefore, when these banks don't have the money to provide these depositors with their withdrawals, then these banks have to then sell off their investments at a time where their investments are not, it's not an ideal time to sell. Like I said, I buy on down days, I buy on red days, and if I was forced to sell on a down day, forced to sell on a red day, you're going to take a loss. And when banks like Silicon Valley Bank take a loss, so many others will take a loss with them. They're taking a bath, folks. Meanwhile, investors and bank customers have been getting mixed messages about the severity of the problem. While some analysts warn of a lot more pain to come, including continued stock declines and more bank failures, others insist the problem has been overstated. I can understand how you could approach it from both sides, two sides of this coin, but I think perhaps maybe what we're overlooking here is the biggest problem of all, and that's the bailout, that they're not calling a bailout. It says here that Solita Marcelli, UBS Global Wealth Management's Chief America's Investment Officer, wrote in a note on Monday, "We believe some of the recent sell-off in banks has been overdone, especially in select universal banks, which remain well capitalized and sufficiently liquid to continue to serve clients." Overdone? I don't think you can consider this overdone when there is proof of what the FDIC had already stated would happen and predicted, that we would experience a banking shutdown, collapse, crash on a Friday.
They discussed this openly. The FDIC openly in their meetings discussed it, and they have a plan. The plan is, number one, we got to stop people from panicking first. Okay, we've got to move to block off parts of the economy and certain banks so that people can't take withdrawals from their money. We've got to stop withdrawals, right? So if you want to go get your money out, sorry, not available. We're stopping it. We're shutting it down. So we've already seen this. Of course, we've seen this in some European countries. We know what happened in Greece, right? We saw what happened in Afghanistan when people went to the banks to get their money out. And sorry, bank said, your money's not here, it's gone. What? We've been seeing what's happening in Ghana. We've been covering that. And South Africa. And also in some other African countries.
It happened. I don't think that you can call what sound-minded people, worried, panicked, stressed people on the verge, the brink of a recession, doing what they did. I can't consider that overdone. It's called sound good judgment. Analysts at LPL Financial offered a similar assessment in an email shared with Go Banking Rates. LPL wrote, "At this time, we do not believe the SVB, Silicon Valley Bank, and Signature Bank failures are a deeper sign of things to come. However, we are paying close attention to ongoing developments in the banking sector and in other industries for hints of any widespread contagion. Indeed, more banks may come under distress. 72 FDIC insured banks have failed over the last 10 years, but we are not expecting SVB and SBNY, Silicon Valley Bank, Signature Bank New York, to be the first step on the way to a systemic crisis." Well, folks, guess what? Wouldn't that be exactly what you would want to hear? Yet, if we were to fast forward 2-3 weeks from now, 4 weeks, maybe 6 weeks, maybe 2 months, and we see bigger problems happening back to back to back, once the dominoes get pushed over, remember, fractional reserve banking. Most of these banks are using funds that they don't have. They're banking on luck, hoping, using hope as a plan and a strategy that there won't be a run on withdrawals that they can't produce. Therefore, we have to push the narrative. We have to control and contain the situation so that doesn't happen, because we can't execute on it. And we don't know if the FDIC and the Federal Reserve and these special funding programs and these non-bailouts that we're calling bail-ins are going to be there to support us. So we have to tell everybody everything's fine. However, if everything's not fine, then we can go back on that and say, well, we thought it was fine. Sorry. But that's how capitalism works. Crazy stuff, folks. Crazy stuff, crazy times. And I'm just going to share with you, I'm going to reiterate what I told you guys just a few days ago as I was talking about this liquidity crisis and folks being forced to sell at a loss, panicked, worried, upside down. Inflation's taking a toll on them, the brink of a recession. job loss, layoffs, cuts. The list goes on and on. Cryptocurrency, CBDC in the future, the XRP, SEC back and forth, Bitcoin dropping, Coinbase halting USDC conversions, exchanges going belly up, diversity, security, and cash flow. Diversity, security, and cash flow. These are my 3 pillars. So basically what it boils down to is, would you rather have a bank ledger that you can't gain access to from a bank that's collapsed on a Friday that says you have a lot of money in it? Or would you rather have tangible physical assets that hold their value? Diversity, security, cash flow. Granted, this could be done, executed in a variety of ways. For instance, Hard Assets Alliance, link down below in the description. Go check it out, 100% free link. Diversity in precious metals, physical gold that we saw have a massive spike. After what? After the banks collapsed. So again, I'm buying on the down days. I'm buying on the red days. And as this continues to happen, those days are going to be less likely. And then gold is just going to theoretically continuously increase in value. It only makes sense based on what we have seen already happen in the last few hours, as well as cryptocurrency. I told you guys, fire up that Coinbase. But the key is Coinbase, Crypto.com, Bitcoin, ETH, Ethereum, XRP, Ripple, BTC, altcoins, USDC, Optimus. It doesn't matter. I don't want to diversify only to be left unsecure, just like these banks. Because if you've got a boatload of cash at home, like the CEO of Silicon Valley, or ex-CEO of Silicon Valley Bank, who sold off all his shares, and the bank collapses, guess what? You still got a boatload of cash. But if you got a ledger that said you had a boatload of cash in the bank, and the bank collapses, now it's tied up, it's in limbo. The FDIC is taking over. You're going to have to wait and see what happens. Maybe you're made whole, maybe you're not. Maybe if you've exceeded the $250,000, $250,000 FDIC insurance limit, you're good, maybe not. We'll see what Biden says. We'll see what Janet Yellen does. Versus if I've got it at home, locked up in my safe, or, off-site somewhere else, locked up secure. Security. So why would I not do the same with my cryptocurrency? Why would I leave it on the exchange? I'm going to use cold storage. Again, 100% free links. Ledger Nano X. Check it out. Link in the description. The amount of money that costs to save and protect and hold your own keys, it's a no-brainer. Last but not least, cash flow. We want to have multiple levels and stages of this preparation plan and strategy of diversity, security, and the cash flow adds to that. Therefore, if you were to see a situation where you were insolvent, by way of cash flow, you wouldn't be insolvent for long. You see what I'm saying? Because the money would be continuously flowing. So if you're diverse in an asset class, which I would not be looking to sell my assets right now, again, you'd be selling at the wrong time. You'd be selling in a down market. You'd be selling at a loss. You'd be selling on a red day, theoretically speaking. And I'm not looking to go to my crypto and my cash that's secured. No. Mainly because I'm not in a position where, I'm rubbing two nickels together. You see what I'm saying? Therefore, I've got time. I can wait, okay? But what I can wait on is my cash flow coming in, and not necessarily waiting on the bank to release and relinquish or possibly tell me I'm shit out of luck, because that's how capitalism works. No. My cash flow is going to continuously come in. And this cash flow and this security and this diversity is all going to be tied to businesses, real estate, the stock market, cryptocurrency. These are all going to be vehicles to produce, in my opinion, the greatest ability for maximum wealth building opportunities without relying on the banks just to hold your money hostage at risk, without providing you with a backup plan. They're only providing you with an electronic statement of how much you let them borrow from you, unsecured. You don't want to buy real estate? That's fine. What about REITs, real estate investment trusts? I want physical, tangible assets at my disposal, especially with the likelihood of the day coming where the ones and zeros on the bank ledgers are wiped out, and Mr. Biden comes shuffling in right before he's about to get on a plane and go to California. And he says, sorry, guys, that's how capitalism works. God bless our troops.